In this video, we'll explore some creative and often overlooked rules to manage your finances during high interest rate phases. Rule 1. Prioritize paying off high-interest debt. Debt can feel like a weight around your neck, dragging you down with every interest payment. But during high interest rate phases, that weight can feel like a boulder on your back, crushing you with each passing day. That's why Rule 1 is to prioritize paying off high-interest debt. Think of it this way. Every dollar you owe is a dollar that could be invested in your future. But every dollar you pay in interest is a dollar that's lost forever, a dollar that could have been used for something more valuable. When interest rates are high, that lost dollar becomes even more costly. So, if you want to build a better financial future for yourself, start by freeing yourself from the shackles of high-interest debt. Prioritize paying off those loans with the highest interest rates first, whether that's credit card debt, student loans, or personal loans. It won't be easy. It might mean cutting back on non-essential expenses, like eating out or buying new clothes. It might mean taking on extra work, like a side hustle or a part-time job, but the reward will be worth it. Rule 2. Consider refinancing existing loans. Imagine the feeling of relief when you see your monthly payment drop by 50%, or when you realize you'll save thousands of dollars in interest over the life of your loan. Imagine the sense of empowerment when you take control of your debt and turn it into an asset for your financial future. To refinance, start by researching lenders and comparing rates. Look for lenders who offer low interest rates, favorable terms, and a reputation for transparency and fairness. Don't be afraid to negotiate with lenders or shop around for the best deal. And don't forget the benefits of refinancing beyond the obvious financial ones. Refinancing can also help you simplify your finances, reduce stress, and improve your overall financial health. It can be a step towards financial freedom and the life you've always wanted. Rule 3. Invest in high-interest savings accounts. It's no secret that saving money can be a challenge, especially during high-interest rate phases when inflation can quickly eat away at your hard-earned cash. But what if there was a way to earn money on your savings, while also keeping them safe and easily accessible? Enter Rule 3. Invest in high-interest savings accounts. These accounts offer higher interest rates than traditional savings accounts, allowing you to earn more money on your savings without taking on additional risk. Imagine the feeling of satisfaction when you see your savings account balance grow each month. Even while you're sleeping. Imagine the peace of mind that comes with knowing your money is safe and secure, even during volatile economic times. And don't forget the power of compound interest. By reinvesting your interest earnings back into your savings account, you can accelerate your savings growth and achieve your financial goals even faster. Rule 4. Diversify your investment portfolio. To diversify your investment portfolio, start by assessing your risk tolerance and investment goals. Consider investing in a mix of stocks, bonds, and alternative investments like real estate or commodities. Look for opportunities in different sectors and geographies and consider working with a financial advisor to guide your investment strategy. Remember, diversification is not a one-time event, but an ongoing process. Regularly review your portfolio and rebalance as needed to ensure your investments remain aligned with your goals and risk tolerance. And don't forget the importance of patience and discipline. Investing is a long-term game, and success requires a steady hand and a commitment to your strategy. So, don't put all your eggs in one basket. Diversify your investment portfolio and unlock the full potential of your wealth. Building strategy. With a little creativity, research, and discipline, you can achieve financial freedom and live the life you've always dreamed of. Rule 5. Avoid taking on new debt. To avoid taking on new debt, start by setting a budget and sticking to it. Look for ways to reduce your expenses and increase your income, whether that means negotiating your bills, taking on a side hustle, or finding ways to save on everyday expenses. If you do need to make a big purchase or cover an unexpected expense, consider alternative options like borrowing from your emergency fund or using a 0% interest credit card with a plan to pay off the balance before the promotional period ends. Remember, every dollar you don't spend on debt payments is a dollar you can use to invest in your future or enjoy the present moment. Rule 6. Increase your emergency fund. Life is full of surprises, and during high interest rate phases, unexpected expenses can quickly add up. That's why it's crucial to have an emergency fund in place to cover unexpected costs and maintain your financial stability. You never know when a medical emergency, a car breakdown, or a job loss may occur, and having a cushion to fall back on can help you weather the storm and come out stronger on the other side. To increase your emergency fund, consider setting aside a portion of each paycheck or cutting back on non-essential expenses. Look for ways to reduce your bills, whether that means negotiating with service providers or finding cheaper alternatives. And don't forget the power of automation. Setting up automatic transfers from your checking account to your emergency fund can help you save consistently and make building your fund a no-brainer. Remember, your emergency fund should be easily accessible and cover at least 3 to 6 months of living expenses. This will give you peace of mind knowing you have a financial safety net in place in case of unexpected events. Rule 7. Negotiate for lower interest rates. Instead of just accepting the interest rates you're given, try negotiating with your lenders to see if you can secure a lower rate. This can be especially effective if you have a good credit score and a history of on-time payments. Start by doing your research and finding out what other lenders are offering for similar loans or credit cards. This will give you leverage when negotiating with your current lender and show that you're a savvy borrower who's not afraid to shop around. When you're ready to negotiate, be polite but firm. Explain your situation and why you think you deserve a lower interest rate. Highlight any positive changes in your credit score or financial situation that may make you a lower-risk borrower. And don't be afraid to walk away if you're not getting the rates you want. There are plenty of other lenders out there who may be willing to offer better rates and terms. Remember, every percentage point you save on interest is a percentage point you. Rule 8. Be mindful of inflation. Inflation can be a sneaky thief that eats away at your wealth without you even realizing it. During high interest rate phases, inflation can be especially damaging as the cost of living rises faster than your income and savings can keep up. That's why it's important to be mindful of inflation and take steps to protect your wealth. One way to do this is by investing in assets that have historically kept pace with inflation, such as stocks, real estate, and commodities. But it's not just about investing. Being mindful of inflation also means being conscious of your spending and saving habits. Inflation can make it easy to fall into a trap of living beyond your means, as the cost of goods and services rises. By being mindful of your spending and saving habits, you can stay ahead of inflation and maintain your financial stability. Rule 9. Plan for future interest rate changes. One way to plan for future interest rate changes is to consider fixed-rate loans instead of variable rate loans. Fixed-rate loans provide a stable interest rate over the life of the loan, which can be especially valuable during times of economic uncertainty and interest rate volatility. Another way to plan for future interest rate changes is to create a budget and financial plan that accounts for potential interest rate fluctuations. This can include setting aside a portion of your income for savings, investing in assets that have historically performed well during high interest rate phases, and diversifying your investment portfolio to minimize risk. It's also important to stay informed about economic trends and changes in interest rates, as this can help you make informed decisions about your finances. Follow financial news outlets, consult with financial advisors, and keep an eye on economic indicators such as inflation rates and GDP growth. Rule 10. Seek professional advice. Financial advisors can provide valuable insights and guidance on a wide range of financial topics, including investing, debt management, retirement planning, and more. They can help you develop a comprehensive financial plan that takes into account your unique goals, risk tolerance, and financial situation. It's also important to be honest and transparent with your financial advisor, sharing your goals, concerns, and any relevant financial information. This can help them provide more personalized advice and recommendations that are tailored to your specific needs. Write the chapter. Rule 8. Seek professional advice. Use creative language and write in a unique way. Use different sentence beginnings you haven't used in this chat before.